What is going on, you guys, and welcome back to another video on the channel. My name is Brandon, and on this channel we talk about all types of investment topics, just trying to help you guys become better investors. And in today's video, I'm going to be sharing with you 3 tips for beginner dividend investors. These are 3 tips that if you implement, I guarantee are going to help you out. I say that because I do personally use, or I implement, all 3 of these tips, strategies in my own practice, and this will apply for both whether you're strictly a dividend investor, but also for the average investor or more of a normal investor that does just go out and buy the odd dividend stock. And we'll not waste any time for this video. I will just say, if you do enjoy this, if you find it helpful, feel free to give it a thumbs up. But the first tip is that the entry price that you're buying your dividend stocks at absolutely matters. And this may sound to some like so elementary, so simple, but it's surprising how many people think that when it comes to dividend investing, hey, all I care about is pulling in this dividend, all I care about is the income, and I can go out and buy a stock at whatever price because whatever the share price does, well, hey, that doesn't concern me. I just want to pull in my 2, 3, 4% yield. And in a sense, that is true. Of course, the income, the dividend would be the prime focus, the prime concern for a dividend investor. But we do have to keep in mind that as a stock gets more expensive, in other words, as it goes up in price, well, the dividend yield on that stock correspondingly drops down. They work opposite of each other. And that's quite simply because for our very beginner investors out there, if you have a stock that trades for $100 per share and it pays a $1 dividend, well, that's of course a 1% yield. You pay $100, you get a $1 dividend actually paid out to you, which is the equivalent of 1%. Now, if the share price increases, essentially what that's telling us is we have to go out and pay more money today to get that $1 dividend. The actual dividend payout amount, that doesn't change, and that's why our yield drops down. Now, the reverse is true. If a stock is dropping and getting cheaper and cheaper, we can actually invest less dollars to go out and get the same $1 dividend in this example, hence why the yield goes up as the share price drops down. And when you're out trying to add a stock to your portfolio, you still very much want to be considering the starting yield. You do not want to come in with a fixed mindset saying, I can go out and buy any stock at any given time because all I care about is the dividend, the yield. True, again, but you still want to be buying for as low as possible, buying the cheapest shares as possible, so you're starting off with the highest yield possible. We call it your starting yield. Now, the second tip it kind of builds off that. I'll explain why in a second. It is not to use a drip. And I know how much drips are loved. A drip being a dividend reinvestment plan or a dividend reinvestment program, essentially meaning when you own a stock that pays a dividend, each of those dividends automatically goes back in and buys more shares of the stock. I personally think that a great option is to avoid the drips and collect the dividends in cash instead. And as I touched on at the top of this video, these are all strategies that I personally implement. And from my experience, in my opinion, I would much rather have my dividends flowing into my portfolio as cash, which gives me a ton more flexibility in terms of what to do with them. I love the idea of the simplicity of just having your dividends buy more shares, just have a dividend reinvestment plan, a drip running on a specific stock. But if you take your dividends in cash, you always have that option. You can always go in and buy more shares of that specific stock, but you are opening a door to say, hey, maybe I want to deploy these dividends somewhere else. Maybe there's a dividend stock or just another area of your portfolio that you'd rather have those dividends flowing to. Without a drip, you do have that flexibility. With a drip, you're kind of locked in. And, kind of touching on that last point about the share price really mattering with dividend stocks, let's say you took a company like McDonald's. If this stock was just trending up and it was just totally on a roll, it was climbing and climbing and climbing, getting, let's call it, more and more expensive. If you had a drip running, in theory, you're just buying more and more shares of a stock or of an asset as it continues to get more and more expensive. If you decide to just strip out that drip and take those dividends as cash, again, you can avoid buying the overpriced asset or the more and more expensive asset, and then you have the flexibility to move that anywhere else in your portfolio, hold it as cash even, or go out and really just buy any more dividend stocks, any investment. That's my personal opinion. Feel free to agree or disagree, but that's my second tip for this video. The third tip when it comes to dividend investing, and this is a really good one as well, do not limit yourself to your local market when it comes to choosing dividend stocks. And this is one that, as a Canadian, I know we have a ton of Canadian investors on the channel. You can really relate to this. There tends to be a very, very strong bias to investing in your local market. You know, whether that's Canadians investing in Canada, whether that's Americans investing in in the United States, let's understand that each country, each economy, they all have their unique positives and negatives in terms of the different sectors that they would call strong, different areas that they may call weak. I take Canada, for example. In my opinion, Canada has some awesome sectors when it comes to dividends. When you think of things like the financial sector, you take a look at the big five banks, take TD Bank, Royal Bank, CIBC, BMO, etc., as well as things like the energy sector, of course, very strong here in Canada. You got some great dividend payers in companies like Cenovus and Suncor and Canna, Husky. Materials, another very prominent, gold, for example, another very prominent sector in Canada. And that's, of course, because those are naturally found. That's kind of the breakdown of how the Canadian economy is built. So it's natural to have some great investment options in those given sectors. And I always do like to mention as well the telecoms, another great one that I really like in Canada, Rogers, Bell, Telus, etc. But if I were to go out and say, hey, I want to add some tech exposure to my portfolio, or I want to go out and find a consumer staples dividend stock, I probably wouldn't lean on the Canadian market. I'd like to look somewhere like America, where they have, the General Mills and the Campbell Soups and a lot more variety, in terms of consumer discretionary stocks like Nike, Under Armour, if that was a company I'm looking for. Each country has their own pros and their own cons. And that goes for even international, right? Asia, Europe, company like Nestle, that comes to mind. There are a ton of great dividend options in all areas of the globe. And I would not restrict yourself to saying, hey, I'm a Canadian investor, so I only want to invest in Canadian stocks. When you look at the overall balance of your portfolio, when you look at the type of assets that you're holding, if you want to get exposure to the different areas of the market, the different industries, the different sectors, my third tip to you is look abroad to countries where they may have companies, better suited companies than what they offer in your local market. And I know you can get all caught up in the tax situation and maybe currency exchanges, but that really is a topic for another video. In many cases, you can go out and buy international stocks as well. Even as things like an ADR, you can go out and buy them here on our local North American market, so it's not tricky. I'm not trying to go out and say go out and buy stocks on the Hong Kong market, and just look abroad when it comes to picking stocks and building up a dividend portfolio. Leave your thoughts on my 3 tips down below this video, whether you like them, whether you agree with them, whether you disagree with them. I'd be more than happy to hear your opinions on these. If you enjoyed the video, feel free to give it a thumbs up and subscribe for more content. We post videos like this every week, all sorts of investment topics, and do hit the bell for notifications as well so you can be notified when we make a future upload. As always, if you are a beginner to the stock market and you don't have your stuff set up, you don't know how to set up an account, you don't know how to build a portfolio, but you want to go out and start investing in dividends, you want to go out, start having your money work for you, definitely click that first link down in the description below. You can find out more about our investing academy, where we're taking beginners from absolutely nothing to having their portfolios built, often in about a week or so, through our online training program. But as always, I thank you guys for watching. I hope you enjoyed the quick video, and I'll see you in the next one.